All right. Well, thank you everyone for joining today's panel, Diversifying Institutional Partnerships in Digital Assets. We think we have an exciting discussion in store for you today. I'm Adam Sporn. I lead BitGo's prime brokerage and U.S. institutional sales teams. I joined BitGo a little over 2 years ago. Prior, I spent 20 years in traditional finance, focused on prime brokerage, securities lending, and custody at Morgan Stanley, BNY Mellon, and State Street. A month ago, it was announced that 21 Shares added BitGo as a custodian for their BTC and ETH ETFs, which was launched earlier this year. We see this in traditional finance where large asset managers or hedge funds use multiple custodians or prime brokers to diversify their risk and mitigate single points of failure. 21 Shares was one of the first ETF issuers to take this concept into digital assets. So we'll drill down further on the benefits of the multi-custodial approach throughout today's discussion. And to help us do this, we have a great panel, as I'm joined by Steve Scott from BitGo and Andrew Jacobson, Bart Michalchuk, and Anton Kozlov from 21 Shares. And I'll let them introduce themselves, starting with Steve.
Good morning, everyone. I'm Steve Scott, working with Adam here at BitGo Institutional Sales, covering funds, asset managers, ETFs. Been in the finance industry for around 25 years now. Worked for Morgan Stanley for the last 18 in a similar with Adam in prime brokerage and securities lending, and before that was working at hedge funds and broker dealers.
Andrew?
Sure. Thanks, guys. Delighted to be here. I'm the global head of legal at 21 Shares, where I oversee legal compliance, risk, and regulatory affairs. Started my career in government as an enforcement attorney. Spent a number of years at a prominent law firm doing funds work, and now lead the legal team over at 21 Shares. Over to you, Bart.
Awesome. Thank you, Andrew. I'm Bart Michalchuk. I am the head of portfolio management for the firm. On a day-to-day basis, I focus on ensuring our ETFs are actually running as advertised. Joined 21 Shares last year, came from DRW Cumberland, where I focused on crypto market making. Before that, I spent a few years running a long-short crypto hedge fund. And before that, I spent about 10 years on the buy side in TradFi, focusing on commodities and FX markets.
Great. And Anton?
Yep. Thanks. So hi, everyone. My name is Anton Kozlov. I'm the distribution lead for the US ETF business at 21 Shares, based out of New York here. I spent the last 5 years working in the digital asset space professionally. So prior to 21 Shares, I was at a crypto brokerage and trading technology platform called Epiphany. And then prior to that, I was at one of the original peer-to-peer Bitcoin exchanges called Taxful. Before I got into the crypto space, I spent about a decade in the financial services realm. So working for large organizations such as S&P and ICE in various sales and business development roles.
Great, thanks. Yeah, so I'll kick it off with some questions that I prepared, but we do plan to leave a few minutes at the end for Q&A. So for the attendees, please feel free to submit your questions using the chat function, and we'll get to them towards the end of the discussion. So to kick it off, maybe Steve, I'll come to you first. From the perspective of the end investor, how is digital asset custody different from traditional asset custody? And can you talk through BitGo's track record of safeguarding client assets and what differentiates BitGo from other custodians?
Yeah, thanks, Adam. So it's a fair bit to unpack there. I think the first thing we want to start with is what's the real difference between the two? Coming from traditional finance, it's a centralized platform, where you have clearing agencies that essentially settle and do these transfers. Here in crypto, it's a decentralized product. So each custodian has their own methods to store cryptographic keys, materials, and to make sure that assets are held safely and that the transactions are signed off correctly. So as everyone knows, there's the saying, not your keys, not your coins. When it comes to custody, it's the fiduciary duty of the custodian to hold those keys safely on client's behalf. So when it comes to the technology behind this, there's a whole bunch of stuff that goes on here. I think there's a bit of a myth to know at how much technology and people are involved to have this asset stored in a safe environment. Firstly, a lot of this is all done, and especially in our environment, in a cold environment where things are completely offline. There are physical vaults involved where key materials held. There's offline HSMs, which are like hardware security modules for doing the signings. There's a whole bunch of segregation of duties. So when you're thinking about it from a crypto standpoint, there's a lot of those elements that go into making sure the safety and security is there. I think obviously the sort of TradFi crypto custodians are now looking at this space. SAB 121 was an area where it was, which is an accounting bulletin, which is an area that hindered the adoption of traditional custodians in the space. But when you look at it, it's really the OGs like BitGo who've been doing this for over 10 years and signed millions and millions of transactions. And the new custodians are relatively untested at this point. So how does BitGo sort of stack up here, and how do we look at as a company? Well, we're a regulated institution. We think of ourselves as a qualified custodian. We have both a South Dakota and a New York trust business. Our regulated businesses carry SOC 1 Type 2s and SOC 2 Type 2s, which are operational and technical standards, audited procedures, making sure that we're following that year on year. We have an insurance policy that covers for a loss of keys, theft of keys, insider threats, and that's running at $250 million for an incident. And then all of our trust entities are bankruptcy remote. So there's no commingling of firm assets with clients. It's purely an entity that's there to hold the assets and store. On top of that, you've got this whole other bit of technology that sits on the front end, which is the policy engines, the things that approvers to actually move those assets off platform before you even get to the signing of the materials and the cryptographic things that we need to do with the keys. So one thing that we always say is not all digital assets custody is the same. Even within our own space, different companies do this in different ways. We don't use any third-party software. We do this all on our own proprietary business, and we keep things fully cold and offline. Lastly, I would say there is, from an end standpoint, just on the ETFs, we already have 3 ETFs that are currently we're looking after. Hashdex on day 1, CoinShares after launch, and then 21 shares just recently. The second part of your question, Adam, talking through the track record and what differentiates BitGo, we've been doing this as well. BitGo started off as a wallet platform, and you can still sign up and get wallets now through our online portal. But we launched our trust business in 2018, and we had our wallet business running since 2013. So well over 10 years. We've had no hacks, no loss of keys in that time. We're the second largest digital assets custodian in the US with tens of billions of dollars. A lot of the Bitcoin on-chain transactions run through our network. I think it was up to around 20% of on-chain transactions running through the BitGo ecosystem. And BitGo supports a lot of companies at the back end. So a lot of exchanges use BitGo as a wallet technology. Trading firms, wallet providers, and even other custodians can use BitGo at the back end. The reason you may not come across BitGo as much is we don't have a retail facing arm. It's really serving predominantly institutions, and that's where the focus has been. And that's why we've been working in the background, but now you're starting to see more of BitGo because we're facing off against the ETFs, etc.
Great. Thanks for that, Steve. And Bart, maybe I'll turn to you, just as it'd be great to get a view from the asset management side of what are some custody best practices for crypto asset managers, and what led 21 Shares to decide to go to a multi-custodial approach for their ETFs?
Yeah, thank you, Adam. I would say that diversifying your custody base is critical. And I think maybe many TradFi asset managers learned that lesson the hard way during the great financial crisis of 2008 and 2019. As far as digital assets go, I think the reasons to diversify crypto custody are in fact quite similar to why you would want to diversify in TradFi, right? You want operational flexibility, you want optionality, you don't want that single point of failure. So really it's all about risk mitigation. And perhaps at this point is somewhat unique to crypto in that diversifying your custody base in digital assets also expands your access to insurance coverage, which for us is a big plus. In terms of best practices, I think I think this list is quite long, so maybe I can hit on some of the most important points. I think first and foremost, you really want to work with a custodian that has a long-standing track record of overseeing and safeguarding assets for institutional clients. Of course, BitGo has been around for quite a long time. BitGo is one of the OG custodians, and so we're really happy to partner with the team. Beyond that, from a sort of a day-to-day trading and operations perspective, I think you want to make sure you can trade out of your cold storage wallets directly 100% of the time. I think you want to make sure that you can enforce maker-checker systems when creating and approving transactions. I think you want to make sure that the SLA on the transfer of assets meets your own expectations, depending on whether you're an ETF issuer or a fast-moving hedge fund. And I think beyond that, you want to make sure that your assets are in fact segregated, that they're bankruptcy remote. I think Andrew will have a lot to say about that in a little bit. And I think maybe zooming out a little bit, I think we have kind of discussed most of the relevant points here, but I think if we think of an issuer, if we think of crypto ETPs as basically wrappers for institutional risk management, a large part of optimal risk management is really just ensuring that you're not subject to this single point of failure. It's really about risk mitigation. And thinking even about the bigger picture, I think 21 Shares and other asset managers are always looking forward to new products, right? Not just over the next year, but over the course of the 5 years. And so for us, expanding our custody base really allows us to make sure that some of the features that we will want to have in our products in the future, like staking and proof of reserve, are actually enabled by the custodians we're working with. So that's a lot, but I think those are like the key points we thought about when deciding to expand our custody base earlier this year.
Great, thanks for that. And maybe it'd be great to turn it over to Andrew to get the legal perspective of why do issuers care about custodians being regulated, and what other considerations should issuers and investors think about from a legal perspective, and what due diligence took place to add other custodians like BitGo?
Great question. I think first, issuers care about a number of things. I think at the front is we care what investors want, and investors want their assets to be protected, full stop. So that's really the first thing that we think about. We also think about our legal obligations. We have a duty to make sure investor assets are safe, to make sure our products function properly. And so we take that really seriously. And so, 21 Shares as a firm has a really high standard of excellence when it comes to, what does the customer want? How can we keep them safe? It's something we've been doing since 2018 in Europe, and really more recently in the United States. And so what does that mean? Kind of breaking that down, what does that mean? I think at the outset, we view regulation as both a way to help innovation, but also a way to protect innovation once investors get into that space. And so in crypto, we don't view regulation as a blocker in crypto. We view it as an enabler. And so we look to the aspects of regulations that we think can grow the business. You look at custody. The regulatory status of a custodian is really important to us. It's important for a number of reasons. I think first, what laws, what rules, what regulations is the custodian subject to? How often is that custodian examined by their prudential regulator? How seriously does the custodian take their regulatory obligations? We really, what would happen in an insolvency type situation under law? These are the types of things that we think of the same way that BitGo is thinking about those things. That's how we think of where we're putting our clients' funds and what are we doing to make sure it's safe. So at really a high level, regulation in our view is an enabler, and we view it as a sword and a shield in many ways to protect clients.
Great, thanks for that. And being on the other side of the due diligence, we can certainly say that it is a long and thorough process from the 21 Shares team. So I'll turn it over to Anton. Anton, what are the near-term catalysts and drivers for the price on BTC and ETH, and how are you seeing the ETFs demand for the ETFs potentially broaden to seeing investors looking for exposure to other vehicles outside of BTC?
Yeah, sure. So to the first part of your question, and then I'll turn it over to Bart for his input as well, as the portfolio manager at 21 Shares. But what I think are some important tailwinds and headwinds to consider for Bitcoin's outlook in the near term is one, the macro environment. So we're going into a lower interest rate cycle. That obviously, looking at Bitcoin before, with interest rates up, it's been suppressed, and potentially this could be a nice tailwind for the next foreseeable future. Then we have to also consider there was a period of forced selling for Bitcoin. So you have the Mt. Gox distribution, German government sales. So that goes into sort of the supply and demand dynamics that are pretty positive going into the next 3 to 6 months. Additionally, on the supply and demand side, when you look at the institutional adoption, so we've had the ETFs come out, and the Bitcoin purchased by the ETFs exceeds the new Bitcoin mined. So that plus the recent halving, which reduces Bitcoin block rewards to miners by half, which creates sort of a deflationary supply pressure there. If you take all those things together, and if Bitcoin demand holds steady at the very least, I think we have sort of a positive catalyst for price going up. But Bart, I'd like to turn it over to you as well for your thoughts and any additional.
I think you took most of the points I wanted to mention. So perhaps one additional point that I'll throw in there is the BTC halving, which occurred in April this year. I think it came and went, hasn't really kind of resulted in significant price appreciation since then. But I think if you kind of look back at history and look at returns post halvings during the previous cycles in 2020 and 2016, it is just a fact that the impact of the halving, which this year removed around 10 billion of annual BTC production per year, that impact just takes time to make its way through the market. And typically it seems like the interesting price action doesn't begin until about 225 or 250 days after the halving, which kind of this time around puts us in maybe December, January timeframe. So markets haven't really focused on this of late because we have had a significant forced selling from previously seized Bitcoins and previous bankruptcies. But I still do kind of think about that as a really important driver of price action for the next year or so. We just have to be a little bit patient, and I think good things will happen. So from my perspective, I'm pretty excited for the next 12 months. I think the confluence of institutional adoption, the halving, and growth in global liquidity will potentially result in really interesting price action. Having said that, I think long-term investors are best thinking about long-term returns. The 12 months next 12 months don't really matter. It's really about the next 12 years, the next 20 years. As long as investors really take that long-term view, I think historically they have done well by doing that. And I would encourage everyone to kind of take the same forward approach. In terms of ETH, ETH BTC has been in a 2-year-long downtrend. I think ETH has lost some of its narrative, but today it is still the largest smart contract-based platform in the world. So we're very much looking forward to seeing ETH actually continue leading on innovation and perhaps getting past the ultrasound money narrative, which today isn't really in the market. So good things to come, we think, but these things take time. Blockchain networks are trying to re-architect how we interact with each other on a day-to-day basis. And that just takes time. It won't happen over the course of 5 or 10 years. It'll happen over the course of 20 to 30 years. So, we have to be patient.
Can I just say there, Bart, and I think similar situation, like as a custodian, we're involved in helping a lot of these almost supply overhang situations. Like we were the helper there in Mt. Gox distributions. We hold the FTX bankruptcy assets there. So like you can see that there's obviously been over this last year and a half, like so many of these working through the system. And, while they all didn't come at once, they all came within a very sort of short period from the ETF. And I think that we saw that ETF run up and then kind of the overhang come in, and, we've been trading essentially sideways for the last few months.
Yeah, for sure. The market has to just that supply. Yeah, go ahead, Anton.
Yeah, no, to kind of the second part of Adam's question also on, institutional adoption of Bitcoin. And I'd like to kind of highlight some of the trends that we're seeing. Also, we have 2 quarters of 13F filings that have been out now. So, there's some interesting findings in those. So if you look at kind of our AUM, so we're at about 3 billion for the ARCB product. We've had about 2.5 billion of inflows year to date, with approximately 400 million in September alone. Now, to start October, we've had outflows, but I think one of the trends we've noticed is that there's actually very strong activity on the hedge fund and market maker side, using our ETF specifically due to the efficiency of the primary market setup. the transparency of it, the risk management practices that we have, including this multi-custodial offering that we've now employed. So, you know, there's something called the basis trade, which the hedge funds and market makers are actively employing. So, you know, we have some assets that are not as sticky. They're kind of shorter term, but that just speaks to the ability of these funds to go in and out of the product efficiently. Now, kind of zooming out a bit too and taking like a 30,000-foot view on the flows, the ETF industry as a whole exceeded about 700 billion in flows year to date, while the Bitcoin ETFs are at around 19 billion. So that just gives you a picture of sort of that we're still a small fraction of the overall ETF pie, and that there's still a lot of room to go. So despite like the relative success of, you know, the Bitcoin ETFs, I think there's still just a lot more room to grow against other asset classes. And we're seeing interest pick up on the institutional side, both on the wealth management segment, family offices. You know, I was at a family office event this week. A lot of questions about crypto. Family offices that hold it directly, they're actually realizing the benefits of using the ETF vehicle for its efficiency, and things like, you know, basically getting institutional grade custody from, for example, BitGo, that also isn't available to retail end investors. And we're basically taking economies of scale and we're democratizing that custody and providing it through the ETF wrapper at a very low cost. So I think all those things are drivers of Bitcoin adoption, and I think it's going to continue further. You know, as the supply and demand dynamics that we mentioned before are going to provide some tailwinds to Bitcoin as well. So,
yeah, and if I could just add to that really quickly. Sorry, Adam. To me, the big picture is there are pension funds today that own Bitcoin ETFs. When I started in the space in 2017, you know, I would have never imagined that. And so the institutions are here, they're coming, but it takes time. Every RIA has to execute their due diligence. That takes time. In the same way that 21 Shares took their time when doing due diligence on BitGo. So again, it's all coming, but it takes time. It doesn't happen at a snap of a finger. So we have to be patient. But they're definitely here. They're having conversations with us and other issuers, and we're really excited for what's to come. And of course, what already has happened has been quite exciting, coming from someone who has been in the space for a long time. It's almost hard to imagine if you just kind of sit back and think about where we are today relative to 6-7 years ago. It's absolutely wild.
And there's also a real hunger for educational content and educational materials, timely market updates, kind of filtering out the noise. There's a lot going on in crypto on a day-to-day basis. So the feedback that we get from investors is around a few questions. One is how do we value this stuff? Bitcoin, Ethereum, Solana. We actually have different valuation frameworks that we provide. Relative value, intrinsic valuation frameworks. So that's all kind of available through the research that we're providing. We do timely kind of market updates. So we can see the interest in getting educated on the space, which is always great to see. And it's from some of these kind of client segments that we didn't typically see in the past prior to the ETFs.
Great. Well, sorry, you answered my follow-up questions. I was going to say if you're starting to see any more interest from the PEF space. So it is good to see that they are starting to do their due diligence.
Mm-hmm. Absolutely.
I think we might have lost Adam.
We may have lost Adam. No, there we're back. Sorry. No problem.
I'll go to the next question. Steve, what are some other trends you're seeing in the custody space as digital asset strategies evolve, and how does BitGo keep up with the pace of new assets and products?
Yeah, so we've actually had a fair few questions coming around product and what BitGo can do. So hopefully this will answer some of that as well. Yeah. So once again, I break down the first part into two places. The first is, what do the ETFs need? That's what this whole webinar is about, which has really been the diversification. And I think about the diversification in two areas. One is counterparty risk protection, so the bankruptcy remoteness of the product. And then the second product is the general business disruption. So, primarily operational. If there's an issue at the custodian, they can't get the assets off the platform, they have a redemption. What do they do if you have only one particular custodian to service? So having that across multiple custodians helps you mitigate that risk. I think broadly, what's happening on the client base and what's happening there, for us in the conversations we're happening is it's really about deploying the assets, not just holding them. So that comes down to liquidity, and that's either on the trade side of the business or on the staking side of the business. Now, the ETFs can't stake in their current state here in the US. Canadians can stake, but when it comes to regular assets, people are looking to get that additional rewards generated out of these idle assets. What else is sort of in the focus is obviously the ETFs are taking up a lot of the Bitcoin and the Ethereum vanilla purchases, and where people are now trading in the brokerage accounts. So crypto managers are looking for like something a little different. They're looking at maybe index funds launching. There's many types of indexes that you can now follow, like NASDAQ or CoinDesk 20. So managers are looking to see if they could go down that place to differentiate. So that's another thing. And then obviously over time, potentially we get like a multi-asset ETF, which is something that would open up to further gain in the US. Product-wise, this is all about technology. I mean, realistically, yes, it has finance. Yes, it's a lot of bankers working in this space now, but the company is heavily invested in engineers. We have, I think, around 60% of our company is just engineers. So we're consistently trying to build those technology. I think when you look at the actual products and you go down to this at an asset level, BitGo supporting over around 850 coins and tokens and about 30 layer one. So that means like the sort of main base level chains like Ethereum and Bitcoin and Cardano, Solana, etc. And we're constantly looking to add. We're adding 5 to 10 tokens generally a week, and we're adding multiple layer ones. And the whole concept there is to increase the breadth in the top 100 that all assets can be custodian with a qualified custodian. Staking, something that we've invested heavily in. We're doing over 20 chains. We've just got BNB up and running. Eigenlayer is a big launch, and Ton staking are all big launches. And then in 2025, BitGo's announced to be launching it's a stablecoin USDS. So multiple things happening on the asset side. Product side, the way I think about this is the main thing clients are looking for, and it's exactly what ETFs are looking at, is counterparty risk reduction products. So we have a thing called the Go network, which allows people to DVP settle. What does that mean? It means that you swap assets instantaneously, real time, not taking risk with each other against counterparts. We allow clients to do off-exchange settlement, which means you don't have to move your assets to an exchange. We have Bitstamp and INX currently on that platform, with Copper integrating through their Clearloop program. And then it's also the connectivity to the OTC desk and using the DVP settlement. So you can trade with an OTC desk and settle on the product, taking no counterparty risk. And finally, I would say tri-party collateral management. Clients looking to segregate their collateral and margin from spot and derivatives business. Lastly, I think on a product basis, one of the questions in the chat's already been around Bitcoin. There's a lot of chat around receiving, I guess, rewards, yield, generating something from Bitcoin. That's something that's coming this quarter. We currently do it through borrow and lend, but there are other ways to generate through essentially staking products like Babylon Core, etc. So it's all about the technology, Adam, and really keeping up and making sure that we have a product that covers not just ETFs, but across the whole crypto ecosystem.
Thank you. So I think you answered some of the questions from Milton, and I see Ron had one about if we can stake certain assets and do OTC trading, and the answer to that one is yes as well. So I will turn it over to Bart. So 21 Shares has seen significant growth in their ETF products since launch. What are some of the biggest challenges from an operational perspective, and how has your team helped prepare for continued inflows in Q4 and beyond?
Yeah, thanks, Adam. So I think for us, for 21 Shares, we've been overseeing crypto-backed ETPs in Europe since 2018 or 2019. We have products in Australia. We're a global business, and all of that means is that we have really optimized and perfected our trading and operational processes over time. And they've stood the test of time through both bull markets and some of the adverse events we've had in crypto over the past couple of years. We're pretty comfortable operating in this digital assets ecosystem. And I think, if we were a new issuer in the U.S., perhaps some of the challenges that we would have faced for us, they were solved many years ago. Having said that, I think the US ETFs are a little bit unique, right, relative to our European products. And I think the biggest differentiating point is the fact that the primary ETF market is cash rather than in kind, which for us means we had to expand our roster of liquidity providers. We had to execute due diligence on everyone. We have to make sure that we're taking all the right steps to mitigate counterparty risk, develop trading policies and procedures. So I would say, for us, maybe it wasn't a challenge, but it was certainly a big focus for us. And I think as we look forward to continued asset growth, for us, really, one of our goals this year was to expand our custody base. And, that was one of our key initiatives. And I'm really happy that we have partnered with BitGo. We're across the finish line, so that's great. And as we look even further forward, I think right now we're kind of focused on ensuring that the existing tech we have internally at 21 Shares is integrated with our US business to ensure that our products are operating smoothly. So it's really about kind of optimizing and perfecting the processes that have been in place for the past 9 months in the US.
Great. Thanks for that. And then Anton, I know you touched on it a little bit, but how any other innovations in the space that you want to touch on that 21 Shares is helping to shape and or new products that you guys are looking at?
Yep. Thanks, Adam. So kind of going back to what Bart was mentioning. So just I think a bit of history about the firm is one point I'd like to highlight on the product innovation side. So we've been running the largest suite of crypto-backed ETPs in the world with over 50 products trading globally. For the past 6 years, we've been managing exclusively digital asset ETPs. So I think that speaks to our product innovation in the space. We have a very diverse product suite, including launching the very first Bitcoin and Ethereum ETPs in Europe, the first crypto basket ETP in Europe as well, and now with the recent ETFs in the US. I think that all speaks to sort of our innovation sort of on the product side. Of course, this multi-custodial model is an industry first, so we're really kind of democratizing institutional grade custody. Especially, I think this is important for the retail segment where they can't normally access this kind of custody. So they're getting basically what institutions would get at a fraction of the cost. And I think, as well, sort of these couple things that I'm about to mention are core to our business model, which is research, data, and capital markets. So on the research side, over the past 6 years where we've been running these products, we've been supporting investors. So kind of going back to what I was saying about really making sure that we provide timely market updates, educational content, and that we're helping investors with questions like portfolio allocation, with how to value Bitcoin, Ethereum, Solana, and other crypto assets, and basically making sure that we're helping to educate our end investors on how to actually approach these very complicated and sometimes fast-moving topics. So we have a team of experts also on the cap market side that essentially offers personalized trade support. So I think that model is quite unique, where we'll help clients with trade execution, finding the optimal execution on large tickets, for example. As well, connecting them with regulated prime brokers for financing. I think that's a pretty unique point. And yeah, on the data side, I think we're doing a lot of interesting stuff. So we have a suite of proprietary Dune analytics dashboards, and Dune is basically like a SQL database on top of the blockchain world. So you can actually analyze any sort of blockchain data in real time. And we've created a number of dashboards that are some of the top dashboards on Dune. For investors to access if they want to do fundamental analysis or if they want to track various trends like tokenization, what's happening on chain basically. And the last thing I want to mention is our transparency in terms of, for example, partnering with Chainlink on proof of reserves and being able to show, using a decentralized network and Chainlink's oracles, being able to actually show our reserves in real time. I think those are all kind of innovative approaches.
Great. Thanks for that, Anton. Andrew, can you provide a couple more examples of concentration risk in digital assets, and how else does 21 Shares mitigate the risk from a legal and regulatory perspective?
I would echo some of the points that Anton made. We take best practices that we've been doing in Europe for some time now and bring them to the US in this asset class. And so, diversifying custody, we've been doing that in Europe for years now. And we were the first mover in the US to do it. And so we take, TradFi best practices, we bring them to crypto, but we also take practices that are well thought out, well worn in Europe and bring them here. And so, when I think about, diversifying concentration risk, it's not just custody. It's really almost every aspect of operating an ETF, every aspect of, the other things we do. Bart mentioned trading and counterparties. We've onboarded a number of counterparties from a trading perspective to protect investors and diversify risks there. Custody is another one, and there are other areas as well. And so, everybody in legal risk and compliance always worries about single points of failure. And I think the fact that we took what we were doing in Europe, took what folks have done in TradFi for a long time now and brought it to crypto, I think is really a great demonstration of our approach here. So that's how we think about it. And you can go down the line and expand on many different areas of the business.
Totally. Thanks, Andrew. Okay, I think we'll turn it over now. We have a couple of submitted questions. First one is, it says, how are you maximizing the use of Bitcoin U custody? I would think about it, maybe a little bit different on how do clients maximize the Bitcoin that they custody, and then the question is, how has security and privacy been improved for your clients? And maybe Steve, I'll turn that one over to you.
Yeah, like I said earlier, so we offer products that allow clients to utilize their assets, whether that be through borrow, lend, staking, etc. But that's all up to the client's discretion. So we don't touch anyone's assets unless we have that authority to do so, and they're usually done in a bilateral nature through documentation. But clients are essentially looking for that as to gain greater yield to unutilized assets. And when you have something like ETH that's producing you 3 or 4% a year, that's a win for the business and cash flows. But on Bitcoin, it's a problem because people are there really for the store of value. Probably as it's predominant. I mean, you can make payments with it, but we generally see it as a store of value and way people are holding it on our platform. But okay, what are you actually going to do to get that additional yield throughout the platform? I think privacy and security, nothing's overly changed here. In terms of the way this has worked from the start, we still do things in the same way from our key materials. I think what we are looking to do and continue is, as clients grow and as larger and larger clients come into the crypto space, they're going to come with more and more demands as they bring more and more of the sort of TradFi nature of requirements into crypto. And I think most of us here have been in crypto for a few years, but you know what? I don't think anyone's been here since 2010. I'm sort of kicking along. So, the industry's brought a lot of traditional people in here to help build this out. And that's led to making sure that clients have really good segregation of duties when they're using the platform, making sure that, there's multiple stages of approvals that, obviously we've got a whole bunch of situations now with AI and the way that things can be done. So there has to be more thought process around how you verify people, how you make sure those metrics are good, because technology continues to grow, and we're at the front end growing that and continuing to make it better. But at the back end, when it comes to the key materials, and we think we do it best in class, and that remains the sort of same and continues.
Thanks, Steve. And for the audience, if there are other questions, please feel free to submit them now. Question, this is for the 21 Shares team. Are you RIA, hedge fund, or retail focused, or do you want to talk a little bit about what your investor base looks like generally?
Yeah, I can comment on that. So thanks for your question. I think we don't ignore any client segment. I think when you look at the ETF wrapper itself, the primary advantage of it is access. So that applies to retail, that applies to institutional. Looking at the 13F filings, we have seen institutional activity pick up, as I mentioned before. But I think there's still probably like a 4-to-1, 5-to-1 ratio of basically retail flows versus institutional flows. So the majority of the flows have been retail. We're doing a lot of stuff to basically help educate that segment. We're also focusing on RIAs to the questions around portfolio allocation, valuation. The hedge funds, that's mainly like a primary markets concern. So it's the efficiency on that side. And really our cap markets team does a lot of work there. So we're tackling kind of all these challenges for our clients across different segments. And we're really focusing on each one kind of individually. So it's a mix.
Got it.
Yeah, if I can maybe just add to that quickly, our client base is diverse, which I think speaks to the value prop of the product, right? It's RIAs, it's hedge funds, it's pension funds, it's family offices, and also retail investors as well. In terms of like client support, we certainly are focused on reaching out and speaking with the institutional side of our client base. But for sure, retail investors are buyers of our products as well.
Thanks, Bart. We had a question about trading security tokens on the secondary market, and do we have any solutions to address this issue? Dana, we do have an OTC desk. Happy to speak to you and see if there's opportunity to help you there. Some questions about insurance, which I think was covered on our $250 million insurance policy. So I think the last question we have is, what is your prediction for where BTC is trading at the end of 2024? And I think we'll probably best to for the asset managers to go first, but Steve, you're feel free to chime in as well. So you want to kick us off, Bart, with what you think?
I don't like this question. My time series econometrics professor told me that the best prediction of prices tomorrow is the price today. So my cop-out answer is $60,488. But beyond that, I do think there are really interesting tailwinds that are going to push prices higher over the next 12 months. I'm not sure if it'll happen by December or sometime next year, but certainly my outlook overall is quite positive. And again, I think investors are really best off taking a much longer time horizon when thinking about this asset.
Great. Anyone else want to chime in and be bold with a prediction?
Well, I think we had 80K by May as one of the sayings, and that never turned up. So I think it's everyone's guess here to where it goes. I mean, we've obviously got an election that people looking at a year end, which is a big event. But either way, I think it goes. Crypto probably benefits in the back end. But I think we all hope it goes higher over time.
Great. Well, with that, I do want to thank the panel for participating today. I think it was hopefully a great session for the audience, and do want to thank 21 Shares for the partnership, and look forward to continue to grow together in Q4 and beyond. So thank you all.
Thank you, Adam and Steve.
Thanks, everyone.
Thank you.
Thanks, everyone.
Thank you.